Friday, March the 20th, and I got my copy of the Wall Street Journal this morning, and I felt I had to get to you and bring some things to your attention. The market is actually up this morning, and I'm afraid that you, like a lot of people, are going to say, wow, it's up 2 days in a row. This must be the turn. The market's come rebounding back, and I just think you couldn't be further from the truth. I think we have a lot of downside in front of us. This article, Corporate Debt Poses Financial Risk, subtitle, Market in Junk-Rated Leveraged Loans Shows Strains in the Sign of a Incoming Credit Crunch. This article requires about 2 or 3 times readings. Because it's complicated, and like all too often, the Wall Street Journal and many of the pundits speak in a language that we are not accustomed to. And what it's basically saying is that it's making a very good comparison to what happened in 2008. And again, please go find the movie, The Big Short. It explains the 2008 crunch or credit crisis better than anything I have ever seen. What it's basically saying is in 2008, the whole credit default swaps, these are bundles of loans that are put out for people because they look at them as a bundle. They're diversified, they're rated by the credit agencies, that they're safe investments. And they are investments that quite often people are seeking higher returns than they can get through CDs and AAA corporate bonds. And so in 2008, what was in these instruments were bad mortgages. They were the mortgages of, like in the Big Short, they talk about pole dancers in Miami, Florida, taking their tips and putting a little money down and going and buying rental property, and then having a balloon mortgage out sometime in the future. And then when that balloon became due, they were unable to pay, and multiply that times the hundreds of thousands, and you have the credit crunch, the credit crisis of 2008. Well, the banking industry and the government came in and made that impossible. It's now, if you go to get a mortgage and you go to a credit originator, you got to have somewhere between 10 and 20% down unless you're on a VA loan. And you got to show that you have income to pay that interest, and you have to pay interest. You don't get balloon loans that there is no interest in principal due until sometime in the future. But they still have those kind of loans available to small corporations. So what has happened is since 2015, with the extremely low interest rates, the junk bond market has flourished, and you have companies who are going out and borrowing money for mergers and acquisitions, as well as just to buy back their own shares. In other words, they will buy back their shares, thus reducing the number of shares outstanding. So when they report their earnings per share looks bigger than what it is. And then that escalates the price in the stock. So they're manipulating the stock price. You add to that corporations then go out. In this article, they speak of Circus du Soleil. We all know what Circus du Soleil is. It's this magnificent Las Vegas and tent traveling act of acrobats and magnificent music and whatever. Well, they are one of those companies that went out and borrowed a lot of money to acquire some other entertainment company, and then that loan was put in a credit default swap, a bundle, and it was marketed, and the buyers were pension funds and elderly investors, and insurance companies. Well, now credit Circus du Soleil is shut down. They aren't going to put a show on for less than 10 people. So now they have no incoming cash. The same situation, they mentioned Dell Technologies. That's Dell. It's now a private company. So private equity did the same thing for Dell. Dell has experienced a slowdown in sales. They represent they talk about a restaurant company that owns Burger King. Same issue. They borrowed money. They have this junk bond sitting in a credit default swap, and they aren't going to be able to make payments. So they make a comparison in this article, and you must get this article. It's going to wake you up. They make a comparison that the exposure in this market is larger than what it was in 2008 in the mortgage-backed securities. Now, in the mortgage-backed securities, it was defaults on homes. This is defaults on businesses. How is that going to escalate? Well, we in my state, Alabama, the governor has come out and said no restaurants are allowed to be open. We have beach communities down in Gulf Shores, the southern part of Alabama. Nobody's allowed on the beaches. Everything is shutting down. Well, that's going to make these companies have no cash flow, so they can't pay the debt service on their debt, and they're going to default. The other thing that I think is really crazy is that, and it makes sense. I saw an interview with a guy, and he owns a bunch of restaurants, and he said, the government is saying that I should continue to pay my employees, and he said, I have 2,000 employees, and I should continue to pay them, and they will offer me low-interest loans to pay them. He said, well, that might be okay if it's for a week, but at a month, I'm laying out quite a bit of money. And he says, and I don't think it's going to be over in a month. At 2 months, I'm laying out twice the money. At 3 months, I'm laying out 3 times the money to take the risk of employment off the employee and transfer it on to myself. What has to happen once the virus is tamed, maybe 3-4 months out in the future? How much business do I have to do to make up for that risk that I took on for my employees? I'm the one who's going to suffer. And I know, and he's right, because I was an employer, all somebody has to do is offer that employee a new shiny object, and the employee will go to work for them. So there is no loyalty. So as a businessman, I have to think of my business and myself first and foremost. And that's what I think is going to happen. How long can the airlines continue to pay employees and then say ticket sales will make that up? No, there's only so many seats on an airplane. You can project out. The only way you can then make that up is then increase your prices dramatically and again, pass it on to the consumer. We're going down a treacherous path here. And to sit and see the market go up again today tells me that once again we are being manipulated. We are being drawn down the path, and people are ignoring this and ignoring the ultimate truth. Be honest with yourself. How long is this going to go on? Is it going to be over on April 1st? No. Will it be done on May 1st? Maybe, but probably not. How about June 1st? Yeah, I think there's a good chance. Well, between now and then, there's going to be a huge amount of defaults. And those companies are never going to be able to recover. Again, go back to my video that I did, I don't even know when, where I first showed you the debt clock. And I told you that this was disaster waiting to happen. Well, it's happening. Don't be lured into the fact that market is up yesterday and then up again today. It is being manipulated for the benefit of the big players. They are coming in and pushing that up so that they can bail out before they drop the worst bomb that this market has ever seen. Whatever you do today, find a way to get to a grocery store, find a way to get out and get a copy of the Wall Street Journal. And this is on the second section, Corporate Debt Poses Financial Risk.